Hi, I'm Michael Yardney, and we all know now that if elected, Labor intends to reform the practice of negative gearing. It's going to be one of the big upcoming issues in the federal election. Labor's doing it with the aim of improving housing affordability, or that's what they say. We also know that the coalition is intending to leave negative gearing as it is. But the problem is, Labor's policy is not only going to affect property investors. If they do want to bring down the value of houses, it's going to affect all of us. And today, in the first of these regular Property Insider chats I'm going to have with Dr. Andrew Wilson, Australia's leading housing market economist, we're going to unpack what the changes to negative gearing could mean to us. And I think you're going to find Andrew's got a very different opinion to many other people. So welcome, Andrew.
Thank you, Michael. Yes, I like having a different opinion as long as it's the right one.
Okay. Well, sometimes we agree and sometimes we don't. But we often chat about real estate, and it's often thought, hey, wouldn't it be nice if other people could hear the conversations we're having? Wouldn't it be nice if they were a fly on the wall? And that's exactly what this series of chats is about. Andrew, there's been a lot of information in the media about how bad Labor's proposed changes are going to be for us. Is it really going to be as bad as all that?
Well, look, Michael, I was certainly, one of those leading the charge as a critic of the proposed change to negative gearing, and of course the capital gains discount that the Labor Party has proposed. We've got to remember that that was 4 years ago, nearly, when that policy was first proposed from the ALP, and as with all economics, things have changed, and particularly things have changed significantly in the housing market, as we know. We've really moved through two cyclical phases, in a sense. We've gone from that very strong boom period, particularly in Sydney and Melbourne, that we experienced through 2015, 2016. We moved into a settling period at the beginning of 2018, and now we're in certainly a very steep decline in terms of price growth in 2019, and probably a lengthy period of certainly flat to falling housing market activity. But as with all economic cycles, and probably we get a bit too much groupthink when it comes to, or herd mentality when it comes to analysis of the housing market and of course the general economy. And really this market is being driven now by a remarkable lack of confidence, rather than any particular driver that usually pushes down demand, and with prices falling as a result. And that, of course, are typically higher interest rates or higher unemployment. Now we have neither of those two factors. In fact, we probably have the prospect sooner rather than later of lower interest rates, and we have a very strong economy at the moment. So it's the fear factor that's driving housing markets at the moment. So we've come through those three stages, and my point is that as these market conditions have changed, so do the prospects or the implications for the property market, the housing market, and the economy from these changes that the ALP have proposed. It was initiated in an extraordinary period of growth in our markets, particularly in Sydney and to a lesser degree Melbourne. We had very low numbers, in fact record low numbers in terms of market share and absolute numbers for first home buyers. We had a record high numbers of investors, particularly in the Sydney market. And of course, we had runaway prices growth growing at nearly 15% per annum. And in some years, we had that exceeding 15% per annum in Sydney, and closing in on that high level in Melbourne as well. So of course, the issue then was affordability, fewer first home buyers, lots of investors, particularly speculative investors, that chase those higher prices, and it becomes sort of almost self-fulfilling. More investors, higher prices, more investors. And of course, there were concerns in government circles how to perhaps moderate what was, some concerns about whether this would all end in tears if we did get higher interest rates. But as I said, Michael, all bets are off in terms of I believe, those quite severe implications in those circumstances of a strong market environment of 3 or 4 years ago, compared to what it is now, which is almost 180 degrees different in terms of the nature of the market. And I think we will have a much more benign effect, or it will have a much more benign effect on the housing market, the ALP policy.
Well, Andrew, if we look at this housing downturn, it depends where you look. If you look in Darwin and Perth, it's been a downturn for 4 or 5 years.
Yes,
If you look in Melbourne and Sydney, it's been since the middle of 2017, late
yes,
2017 in Melbourne. But so all the statistics are talking about the overall property market, but
yes.
this particular overall property market slump has actually been going on for quite some time also. It's one of the longest, and it's likely to continue on for a while because the federal election is still coming up,
Yes.
the uncertainty about these policies. But you said a moment ago, the fundamentals are strong. Our economy has slowed a bit, but it's doing okay. The world economy, sure, there's problems with Brexit, sure, there's problems with China and America, but overall it's doing okay. We're creating jobs, we're getting immigrants, the fundamentals are good. It's the fear factor that's scaring people at the moment, Andrew.
Well, it is, Michael. And of course, typically housing market cycles ease with fewer investors as prices start to wane, as the impact of typically lower interest rates eases in terms of prices growth. It becomes higher prices become less of a driver of investor activity. We start to see the cycle moderate, and typically we start seeing higher interest rates in that period, and that acts to bring back I guess, a more stable environment for house price growth. But that wave effect is now dissipated, really, not just from our housing market, but also from our macro economy. And of course, policymakers are scratching their heads as to why monetary policy, low interest rates, hasn't fueled the type of inflationary growth and incomes growth typically that we've seen previously. And this isn't just an Australian conundrum. It's a problem that's faced all advanced economies, US, Eurozone, and the UK. And East Asian economies, whereby low interest rates have not fueled inflation and incomes growth as typically they have in previous stimulatory cycles. And of course, that means we're sort of back to zero, or point one in terms of what policies we have to introduce to get incomes up. And we're starting to see a lot of the introduction of a lot of, I guess, new policy ideas. The ALP are proposing an across-the-board lift in the minimum wage. Of course, there's other stimuluses being proposed, such as big infrastructure projects, likely to see lower interest rates. I'm not sure that'll have much of an effect, as it hasn't before. But this is all part of the interference that we've had from policymakers, including that ALP negative gearing policy. But most, I guess, in terms of impact, was the APRA policy that targeted investors back in 2014-15. We've seen a remarkable collapse, an unprecedented collapse in investor activity in the Australia's housing markets. And really that's right across the board, Michael. And that goes to what you said before, that, we really don't have one housing market, but we did have one investor housing market with investors right across the board from Perth down to Hobart that were affected by these tighter lending conditions. And that meant that investor numbers fell away. Now, again, this sort of lends itself to the different cycle that we're in now, where we've already sort of hit almost rock bottom in terms of investor activity in all our markets. So therefore, the impact of taking away the negative gearing tax concession will not be as great, I believe, on pushing prices down at the level it would have been where we had a more normalised market with higher levels of investors.
So let's just break it down to two things. Number one, Labor was wanting to lower house prices, but that's everybody, and that's going to affect us all. And that's not the way I'd like to see it. My opinion would be, rather than bring the house prices down for everybody and then let new home buyers get in, because once they're in the market, once we actually make it more affordable for them, Andrew, they're not going to want house prices to keep dropping. They're going to say, hey, change the policies and make my property go up in value. Aren't there other ways we can help first home buyers rather than devalue the value of your home and my home? Maybe increasing first homeowner grants, maybe giving stamp duty savings, maybe giving some lower interest rates or some other incentives to specifically help people into the market, as opposed to making my house and yours cheaper.
No, look, I don't agree with stimulatory policies on the demand side, Michael. I think they only act to push up prices. I'm not sure we should be justifying paying taxpayer dollars to get a small proportion of the housing market as homeowners. Australian first home buyers have found their way into the market over the journey. Of course, it's tougher when prices are rising. a good time now for first home buyers generally. They've taken advantage of changes to stamp duty in New South Wales and Victoria. Prices are lower, of course, and we've seen tens of thousands of more first home buyers in the marketplace generally because of government stimulatory packages, one either as grant boosts or as stamp duty concessions over the last 2 years. Now, this will peter out, of course, because those effects are only short term. Those demand side effects are only short term because the savings environment for first home buyers particularly is more a factor of incomes and the level of rents rather than a short term boost to the capacity to purchase. It only pushes up prices. Now, I know this is a little different to what I'm suggesting, but I did think that the policy changes for stamp duty for first home buyers in New South Wales and Victoria and Queensland when they had the first home buyer boost two or 3 years ago were very positive for the market. They did assist first home buyers to get into the market, but I do think that and that was something that kept our markets ticking over to some degree.
It's a different market then, Andrew. At the moment, first home buyers are basically at around average levels again. They've come up, haven't they?
Well, they're above average levels, and the point in terms of market share, but that's really because non-first home buyers are low, and of course so are investors. But I think that first home buyers would have tracked back into the market in these circumstances without those particular stamp duty concessions now, and this would be the time when we would see actually the release of first home buyer capacity, which is of course is always a product of interest rates and house prices. I mean, low interest rates and lower house prices, which is certainly not the typical environment. Usually lower house prices come with higher interest rates, but we've got lower interest rates and lower house prices. Now is a perfect environment for first home buyers. Once again, I think interference in the market can cause more problems than it solves. I think we've seen that quite clearly with the APRA actions, which I think now, given the prospect of lower interest rates rather than higher interest rates, which is what the basis of the APRA action was, to protect the market from supposedly too many investors in case interest rates increase. Now, if interest rates do fall, it's really, in my opinion, a clear repudiation of that APRA policy setting of 4 years ago. And I think this is a salient point in terms of don't interfere with the property market. Just keep lending practices rigid as they are and ensure we have a strong economy, and the market will just follow its normal macroeconomic path. And as I said, I think that these policies that are directed to, I guess, affecting or bringing a positive outcome to certain sections of the market can tend to cause more problems than they solve. And I think it's beware the law of unintended consequences, which is what we are seeing in action now as a response to those APRA policies cracking the investor market.
Clearly, we are seeing a response of lower house prices, more difficulty getting loans, people being unconfident because of APRA. They've gone too far. Was there a reason for APRA to get so worried a couple of years ago in your mind?
Well, it was sort of the new policy on the block was macro-prudential incursions into the macro economy, and that's something New Zealand introduced to try to offset investor activity. It was fear of the bubble, the so-called mysterious bubble, that policymakers bought into. I think that there was a general lack of insight or I guess, in terms of the nature of our housing markets that do have a remarkable history of self-correction through monetary policy and, of course, that's impact on the macro economy. It was like, well, we can't trust the market to find its floor eventually, so we're going to try to create an artificial market, which we think will be a much better outcome.
But in the past, we have been self-regulating our housing market, but it's been that the Reserve Bank has raised interest rates to slow things down, like they did in 2010, 12, like they've done in other times as well. But interestingly, you talked about a bubble. There's another group of people out there, these experts chasing a headline, talking about the debt bubble. Andrew, we've got more debt than we've had in 5,000 years in the history of life. Australia's the worst ever. But they're actually not talking about who owns the debt, what they've got the debt against, and our ability to service the debt.
Well, this is again part of this sort of group think herd mentality that drives the commentariat in our for our housing markets. It's a concern. I mean, they all got it wrong on interest rates. You know, you can smell the burning rubber, that 180-degree turn over the last 6 months about where interest rates are going. I've been railing against predictions of higher interest rates, as you know, Michael, for well over a year, in fact 2 years. There was just no prospect of higher interest rates until income started to grow and inflation started to rise. And we're seeing that now being recognised across the world in terms of central banks are now starting to look at easing, at least keeping interest rates on hold. And the Reserve Bank in here is now saying, well, it's a 50-50 environment in terms of where the next move in rates will go. So look, it is all about I guess the nature of interest rates, and those debt bomb proponents. It was all about measures, internal measures, which perhaps are questionable, about the level of debt that households had, and of course those that had a higher proportion of their income being used for mortgage repayments would be exposed to this, so-called debt bomb if interest rates rose. Now, that's not going to happen. We know that. Now, the doomsayers, of course, just push it out and say, oh, well, they might fall this year, but hey, they're going to rise next year, and it just fuels I guess, the hysteria from this sort of nonsense based on the prospect in terms of the debt bubble of higher interest rates, Michael. And of course, that's the key logic to all of this, is if, regardless of the validity of the measures of debt in terms of income proportion for mortgage repayments, regardless of the validity of that, the whole thing rises and falls on where interest rates go. And we're now, certainly, the momentum is for a cut in interest rates.
Just like the argument that our housing markets are underpinned by migration, and when we stop having migration, then it's all going to collapse. But both sides of Parliament recognise that we do need to keep migration going for our economy, for the jobs. So it's again chasing a headline, it's all going to collapse. But migration may get lowered a little bit. They've lowered it. Scott Morrison's brought it back to 160,000. That's where we are anyway. And there's all those on visas who are here for long term, not in those numbers. We're not going to stop migration. Interest rates aren't going to go up. Are the markets going to collapse, Andrew?
Well, no, Michael. It's just the fear factor, as I've said, and that's very difficult to turn around. Now, it's easy to say, to a buyer or seller that, look, there's nothing to fear but fear itself. But then they say, well, you go and buy a house. It's like, oh, we don't know. It's very difficult. It's who takes the first step. Look, this thing has to find its bottom. It'll probably take most of this year, as you suggested, Michael. We've got an election to get through. Perhaps then a lot of debate about the new property policies if the ALP is successful in winning government. And that'll bring us up to the end of the year, really. And that's the end of the season in a sense. And we'll then look towards an autumn recovery next year. But as you said, Michael, absolutely spot on. The underlying drivers are very positive, and particularly in regard to migration. We talk about the giveaways in the budget coming up, which will likely be significant tax cuts and giveaways in terms of perhaps a bonus for the family allowance. That's all coming from migration, Michael. That the jobs growth that we've had in this country has been fueled to a very significant degree by new people coming here to live. And they've created the incomes growth. They've created the income for the government from PAYE tax receipts. So, look, we need migration in this country. It's always fertile ground for debate when we're in the election cycle, as it is now. But I think all sides of, particularly the ALP and the Liberal Nationals, realise that it's very important, not just for the property industry, but also for the general economy, which we've proven over the last 2 or 3 years to maintain strong migration. This is an economic argument, not a social argument. And, issues such as matching infrastructure to higher levels of migration. Well, if we have a strong budget, if we have a strong economy as a result of higher levels of migration, well, where do you think we're going to get the funding from to provide the infrastructure, to match, general infrastructure for our needs? So, it's a little bit counterintuitive in terms of saying, let's have fewer migrants because we can't support the infrastructure for them when they're providing the income generally for our, not just our infrastructure, but also for our economic benefit.
Andrew, there's so many more things I want to talk to you about. So we're going to come back regularly each week for this Property Insider series, and our viewers can watch them on the video. The podcast listeners can listen to them. Thank you so much. Next week, though, when we come back, we're going to have something really special to talk about because the budget's going to be out.
Yes, very important, Michael. An election budget. So hang on to your hats. It's, I guess, the last chance for the government to win back the electorate. So what are they going to give away, and what will it mean for the property market? It should be very interesting.
Speaking to you about that next week, Andrew. Thanks for your time.
Thank you, Michael.